All right. Hey guys. Again, my name is Ernest from the MMC University. Welcome. I'm going to do another 15 question for you. All right, let me just get to work. As I always telling you, we're gonna have some fun. And as I'm going to do this 15 question, if it is your first time you find us, there's plenty of video for you to watch actually. If you like them, give them a thumbs up. And don't forget to leave a comment. I love reading those comments, especially when you pass those exams and let us know how did you do, how do you like that, you know, really appreciate it. So we're gonna do another 15 question. This is more gonna talk about policy provision, riders and options, and we're gonna take some taxes and question as well. We time it. We're gonna take some of those questions as well. All right, so it doesn't matter what state you are in. If you whatever state you are in, you can have a chance to watch those 15 questions, because this 50 question I'm about to cover here in a minute gonna help you out. The previous video that I posted, I was explaining the policy riders and the provision and the policy riders and the options. And I know some of you guys think it was funny, but whatever you guys say. So again, I'm gonna turn my camera off, okay? Because I want you guys to be able to see all the questions. So that's why I'm gonna turn it off. After that, I'll be back live. Okay, so you're not gonna see me, but you're gonna hear me clear, loud and clear in your ears. So before I go, let me come back very quick. Let me just give you a thumbs up, because you can pass your exam. Okay, you gotta stay focused, guys. I never tell you, I took that exam like 4 times. 4 times. That's why I love it so much. Hopefully you too. 4 damn times. Some of you, probably the first try you're gonna pass it, because hey, you got a chance. I'm not saying because you're lucky, but at least you find those videos that can help you. If this video help you, bless your heart, because I remember when I wanted to find something to help me, I could not find none. And that's the reason I'm putting this video for you guys, okay? And don't forget, after you make the millions, come back. You better send me some checks. If y'all don't send me any checks, I'm gonna have to turn all those videos off. Because that's not nice. That's not nice. After you pass this exam, go make a budget money and you keep all the money in your pocket. That's not damn fine. Okay, let's get to work. Anyway, fasten your seatbelt. Let's get those questions out of the way. Let's go ahead. I'm gonna wait for you. You know the rule. Pause the video and answer the question and go next. An insured has a life insurance policy from a participating company. So if you see it say from a participating company, what they're saying is it's a mutual insurance company. So that's a mutual insurer. Okay. And receive a quarterly dividend. Good for you. Good for your bank account. Okay. He has instructed the company to apply the dividend to increase the death benefits. That's an option. That's a dividend option. So the dividend option that the insured has chosen is what? Is that talking about reduction of premium? Paid up addition? I think addition means increase. Don't you think? It means more, right? I think that could be right. 1 year term, they're talking about a 1 year policy? No. They're talking about keep the dividend check and pay me interest? No. So absolutely. Actually, this is the automatic option. So if you don't pick one of the 6 dividend options, if you don't pick one, remember dividend à crapaud. I keep saying that. If you don't pick one of this, the automatic one is paid up addition. Paid up addition. It will be automatic for you. All right. That's enough for this. It was easy. Next. If a policy has an automatic premium loan, automatic premium loan provision, when does that start actually? This automatic premium loan is begin, okay? Is it to end? I don't know. It's begin after the grace period, which is the 31 days. 30 days, okay? And the automatic premium loan gonna start. But for that to happen, you must have cash value. Remember? In order for the automatic premium loan to kick in, you must have cash value. So you got to know that. Okay, because sometimes people go to that exam and you see that and they might ask you, when does the automatic premium loan begin? After the grace period. Okay. And you should know that after it start after the grace period. So the balance of the loan will be taken out from the debt benefit. That sounds like it's true for me. The policy beneficiary receive the full debt benefits, unless if it was a good policy, yes. The policy beneficiary takes over the policy beneficiary takes over the loan. No. The policy is rendered null and void. What is that? No. So right there, the balance of the loan will be taken out. Yes. So if you owe money from that, you got to pay it. They're gonna take it automatically. Next question. Pause and come back. Which of the following component contain the company promise to pay? This is called you die, we pay. You die, we pay. But when? We have to receive proof of loss. That's mean proof of the person die. We have to receive the proof. Does this talking about the entire contract? No. Insurance clause? Sound like it. Premium mode? What is that? No. Owner's right? No. Look at this. If I take this off, what's left? Ring. If I give you a ring, guess what? You know what that means? If I came to you, you beautiful girl, sexy girl, and I've been talking to you, been dating you, and I bring you a ring, I promise to marry you. That's when you promise to marry the insurance. Okay, I was joking. Stop joking, Ernest. Okay. Okay, good. So you got it. You got my point. So ring, promise, promise, ring, promise, ring, insurance clause. Where are you gonna find it? It's located face of the policy. If they ask you where is it located, now you know. In the face of the policy. That's enough of that jumbo. Next. Which of the following statements is true about policy assignment? When you see the word assignment, you look for the word transfer. There is two assignments, collateral or absolute. So let's see. Okay, is this have transfer? No. Otherwise, nope. Transfer. Ooh, it transfer right. Oh, I like that. It's the same benefit? No. It permits the beneficiary to no. Don't you? Transfer. It transfers rights of ownership from the owner to another person. That's it. Next question. What would be an advantage to naming a contingent or secondary beneficiary? You know what contingent mean? It means next in line. You know, when you go to supermarket, they cannot say contingent, contingent, contingent. Nobody gonna understand what they're talking about. Contingent, contingent, what's that? But the minute they say next, the next person approach, and so on. They say next, and next, and next, and next, and next, next. Yeah, because that's what that means. Next in line. That's what contingent means. Whoever next living. So the reason you put that, just in case the primary beneficiary predeceased, you y'all don't say anything? Why not? Okay. It's ensured that the policy proceedings, no. It's required that someone is who has been, no. It determines who receives the policy benefit if the primary beneficiary is deceased. Oh, primary, you no longer here. So good luck for you. It's allowed they couldn't, nope. So we see. So it determines who receives the policy benefits if the primary beneficiary deceased. That's mean die. Okay. If a life insurance policy has an irrevocable beneficiary designation, irrevocable means you cannot change. Okay? Cannot change. But make sure you know is without. Cannot change, but also make sure you know without. You cannot change it without the person consent, but you can change it with the person consent. So the beneficiary can only change with written permission of the, I like that. Beneficiary cannot be changed. Nope. The owner can always change. Nope. The beneficiary cannot be changed. Some people will pick this one, but that's true. But where's the but? You're missing something. Or you're missing however. See, it's missing something because there's an exception. So I want you to get that. So make sure you don't make that mistake and you pick this one. The correct answer will be this. It can change with the concept. Which of the following protect the insured from an unintentional lapse? Policy lapse. Intentionally for non-payment. Reinstatement. We just paid up. Automatic premium loan. I like that. Because if I don't find this one, unless if I find the grace period. Because those are the two provisions that they allow that protect against non-payment. Extended term, and so the answer is automatic premium loan. But is this gonna start after the grace period? An insured pays an annual premium to his insurer. In return, the insurer promises to pay the benefits in accordance with the term of the contract. This is called what? Acceptance? No, acceptance is when the underwriting department approve the coverage. So that's not acceptance. Consideration, sound like it. Condition and utmost good fit. So the answer is consideration. Remember, there's two parts of the consideration. You as the client, you got to make sure all this statement are true based on your knowledge. And also you got to make sure you pay your premium on time. If you do those two, the company promise they're gonna pay you. Okay, that's what consideration means. The premium paid by the employer in a business life insurance policy are what? If you see the company pay for it, the employer paid the premium, is because they know they're gonna have it as a tax write-off. So it's tax deductible by the employer. They want the tax write-off. That's what they do it. If you have you ever at your job, maybe you see somebody that they say free lunch or free pizza, the job gonna give it to you. It's not free. There is business expenses. It's all business expenses. If they put juice, soda, whatever they give you, all of them gonna be business expenses. Okay. Let's go to the next one. All of the following statements are true regarding tax qualified annuities, except so all is true, one is not true. About tax qualified. If it's qualified, let's see. Annuity earning tax deferred. Yes, if it's qualified, yes. They must be approved by the IRS. True. Withdraw a tax. Yeah, this is true. Employer contribution not tax deductible. Employer contribution are not tax deductible. They are. They're business expense. Okay. All right, let's see. What is the official name for Social Security? Welfare. I'm just kidding. Is it welfare program? No, I'm just kidding. So say insurance. Nope. Define benefit retirement insurance. It sounds like nice, but nope. Qualified pension plan sound nice. Nope. It's all ages for all people. Survivors disability insurance. D. It's a correct answer. They call it OASDI. That's the name. All age survivor disability insurance. That's what another name for Social Security. All right, moving along. Okay, let me just get a quick water. You can do that as well. If you want to get some water, you can. Let's go to the next question. In a direct rollover, how the money transfer from one plan to the next? If I'm doing it rollover, I'm taking this plan from XYZ 401ks. I'm gonna bring it to ABC 401ks. So I did not touch it. So therefore, trustee to participate? Nope. From participant to the new plan? Nope. From the original plan to the original, because nope. It's from trustee to trustee. Trustee to trustee. If you do a direct rollover, it's from trustee to trustee. An employer has sponsored a qualified retirement plan for its employees, where the employer will contribute money whenever a profit realized. So if it is whenever profit realized, it must be when profit realized. Profit sharing plan. Tax, nope. Nope. Yes, profit sharing plan. Profit sharing plan. Because you only gonna put when you realize that you make a profit. Okay. Who may contribute to a KEO plan or HR10 plan? Do you know that, guys, that for self-employed, the 10 is mean 10% ownership. Ownership. That's mean you must own 10% of the business in order for you to qualify for that. And you got to work at least 1,000 hours. Okay. So a manager at a store, corporate executive, partner with at least 5% ownership, self-employed plumber. So you can see self-employed plumber. This one is not enough. You have to be at least 10%. So that's why it's not correct. Okay. So last one. Okay. The president of what? Of university, MMC University, of a manufacturing company has offered one of the company officer a special individual annuity plan that is unavailable to lower echelon employees. The plan would be funded with before tax corporate dollar, and it does not meet the government approval standard. This is a what? Excuse me, I'm sorry. Subject to government standard? No. Illegal? No, it's not illegal. It's non-qualified. That sounds like it's non-qualified. No. So it is a non-qualified plan. Okay. Now, if you got those 15 questions, let me just turn this and stop that. Now I give you 15 questions. You find some from policy provision, riders, and options. Plus you got some on taxes and retirement. So you should well aware what's going on in those section. If you watch the previous one that I just posted, there's another 15 questions just on the riders. So at the end of the day, it's just like you got to focus and study so you can pass the exam, because you can do it as well. If I can do it, you can do it. You just never stop learning. Keep learning. You might go take that exam a couple times, a few times like myself, but stay focused. Eventually, you're going to pass it. May the best player win. See you guys at the top, because the bottom is too crowded. Let's go.